everyone. This section will discuss variance analysis for overhead costs. Overhead cost variances, we measure the difference between actual costs incurred and flexible budget amount. First, I just want to do a quick recap in terms of how do we calculate the cost rate, the overhead allocation rate. First, we need to choose the budget period. Then the next one, we need to select what is the allocation basis for us to allocate the cost to the output that we produce. The third one, then we need to identify the overhead costs associated with each cost allocation basis. Fourth is then to calculate the rate per unit of each cost allocation base. Remember, you have two types of different techniques to allocate overhead costs. First is the conventional technique that many companies usually use. For instance, machine hours to allocate overhead costs to product, or you can use a better one that we call allocate the overhead cost in terms of the activity required to manufacture one finished product. This is what we call ABC costing, activity-based costing. Please also remember that for fixed overhead costs, fixed overhead cost by definition, it is a lump sum cost. It is a total cost that remains unchanged for a given period, despite even though we have different changes in activity level, fixed cost will be still the same within the relevant range. What it means, fixed cost will still the same if the activity level does not go over a maximum capacity of that associated costs. Okay, simple examples. One warehouse that you have can store up to 10,000 boxes. So if the production is not above 10,000 boxes, you can still use one warehouse. Okay, so the cost associated with this warehouse, this is what we call fixed overhead costs. Okay, now let's focus on variable overhead costs first. This type of cost, the variance is kind of like the same as direct cost variances. We have two components, spending variance and efficiency variance. Example, we're going to be still, we are using the same company. Recall that Foxy company is a firm that manufactures and sells jacket. Okay, Foxy's variable overhead costs include energy, machine maintenance, engineering support, and indirect materials. The fixed overhead costs include plant leasing costs, depreciation on plant equipment, and the salaries of the plant managers. The following data for January 2020, when Foxy produced and sold 10,000 jackets. So output units, jacket in this example. So actual result is 10,000, flexible budget amount 10,000, okay, still the same. Machine hours per unit, output actual is 0.45, flexible budget 0.40. So just this is all flexible budget, so we can always use this information to look at the difference. Machine hours, number 3, we are now in number 3, so that's 1 times 2. Actual result in total 4,500 hours needed. According to your standard, you expected to spend a total of 4,000 hours only. Variable overhead costs 130,500, so that's the actual result. According to your budget, 120,000. Variable overhead cost per machine hours 29 for actual. According to your budget, 30. variable overhead cost per output unit, so that you can get this number from dividing the figures in line number 4 and the first one. Actual result is $13.05, for flexible budget is $12. So to calculate the variance for variable overhead costs, we need to make sure that the standard hours for flexible budget is based on your standard 0.4 times the actual quantity of the production. Same as the direct cost variance analysis, for spending variance, you compare the actual rate and the standard rate. So actual rate is $29, standard rate is $30. So $1 different times 4,500 actual hours spent in the production. Therefore, the spending variance is favorable because the rate is lower than the standard rate. What about the efficiency variance? The efficiency variance, actual hours is 4,500, the standard hours is 4,000. Therefore, the variance in total is 15,000, is unfavorable. The sum of these two figures for spending variance and efficiency variance will be equal to 10,500 unfavorable. This is flexible budget variance. Another way to do it is you can do it one by one. To calculate the spending variance is actual rate minus standard rate times the actual hours. Will give you the same result, 4,500 favorable. And if you want to calculate the efficiency variance, you compare the difference between actual hours and standard hours times the standard rates. So in total, 15,000 unfavorable efficiency variance. Let's move on to the second type of overhead, which is fixed overhead cost variance. You also can calculate two types of variance, spending variance and production volume variance. For the spending variance for fixed overhead costs, the formula is you need to compare actual costs incurred and flexible budget amount. The fixed overhead spending variance is the same variance as the fixed overhead flexible budget variance. Note that we don't have any efficiency variance for variable overhead costs, because a lump sum of fixed overhead costs, the total money that you spend for variable overhead costs will not be affected by how efficiently you allocate this overhead cost to the production itself, okay? The second type is production volume variance. The second type of fixed overhead cost variance, this will tell you the indicator of the use of capacity. So the formula for this variance is budgeted fixed overhead cost minus applied fixed overhead cost. However, to interpret the meaning, whether it is, or the impact, whether it is favorable and unfavorable, is slightly different with the remaining variances that we discussed so far. For fixed overhead costs, production volume variance, it is favorable if the applied fixed overhead cost is greater than budgeted fixed overhead. Why? Because it means if the applied fixed overhead cost is greater number, it means fixed overhead cost is divided among a greater number of units. On the other hand, this production volume variance will be unfavorable if the applied fixed overhead cost is less than budgeted fixed overhead cost. Why? Because there were some unused capacity. or the overhead is underallocated. Let me give you an example of the warehouse that I mentioned before. So let's say you rent a warehouse and that warehouse give you a capacity. Let's say now we are manufacturing cars. We are car manufacturers, okay? One massive warehouse can be used to store a total of 100 cars. However, this month the production is only 80 cars. Therefore, the fixed overhead cost that you apply to product of course less because you applied it to 80 cars instead of 100 cars as you expected, as per your standard. This is a sign of there was unused capacity because the warehouse can be used up to store up to 100 cars, but you only have production of 80 cars, okay? Hence, the variance that you calculated from for this month of production will be unfavorable. Let's have a look at the example. Still for the same company, Foxy. Budgeted or planned item, budgeted fixed overhead per month is 276,000. The output is 12,000 jacket. Standard machine hours per unit is 0.4. Standard fixed overhead rate is 57.5 per machine hour. The actual result is actual production 10,000 jacket, actual fixed overhead cost that you spend 285,000, standard hours alone for actual production 0.4 times 10,000 jacket 4,000 hours. So how do you apply overhead cost to 10,000 jacket? You can calculate it from the standard fixed overhead rate times standard hours for actual production. So 57.5, this is the standard fixed overhead rate times 4,000 standard hours for actual production equal to 230,000 fixed overhead costs that you applied. So the actual fixed overhead cost is 285, budgeted is 276, applied is 230,000. The actual compared to budgeted will give you spending variance. It is unfavorable because you spend more than you budgeted. What about production volume variance? The production volume variance will be unfavorable because the fixed overhead cost that you applied to product is less than what you budgeted. So there was unused capacity over there. The total fixed overhead flexible budget variance is only equal to the spending variance. Remember, this is not the sum of spending plus production volume variance. Budget variance will be equal to the spending variance for fixed overhead costs. Here is another summary how to calculate or the concept behind overhead cost variance analysis from your textbook. How do we use this information? So with the spending variance, it will be helpful because it gives us the information to highlight which specific fixed and variable overhead costs that are different from what we budgeted, that are different from what we already set to incur, what we expected to incur. However, the variable overhead efficiency variance, it provides no new information for us. However, you have to calculate this information for bookkeeping reason. For production volume variance, it provides information about how you use the capacity. It is also then useful for you because you can use this one to monitor long-term goals of the operation to use the maximum level of capacity. Here are some reasons that might be related to why the cost variances occur for your fixed overhead costs. Okay, For the spending, for instance, unanticipated changes in price paid for variable overhead resources can be caused by variances in price for supplies or indirect labor, or perhaps new supplier or labor contracts. So I'll leave this table for you to read through. So this is available in your textbook as well in page number 336. How should management use variances? Variances are useful to use in three ways. So first, variances will be used for judging the performance. So after you run the production, you can compare the actual production and the budgeted or the standard to evaluate which area that should be improved. That actually leads to the second one. It facilitated the company to learn how to improve the future performance. Ideally, the companies will be doing this one as regularly. Therefore, it will help them to make continuous improvement. Okay. However, not all variances have to be investigated. How do we choose which variance that should be investigated? There are two main factors that will help you. So which cost that the managers consider important. Remember, for managerial accounting, it always involves a bit of judgment and subjective, which one that you need to focus on. And also you need to think about the cost-benefit trade-off of monitoring individual costs. Whether it will be useful for you to ask your staff to investigate more in terms of this issue. So what the benefit you will get for this one. And also another factors that you need to think about is the size of variance. Does the figure matters to you? If it is like 1% or 0.01% of the budgeted, is it worth investigating that variance? And also look at the trends in variances. If it follows the normal pattern, the normal trend, then do you think that it is worth investigating it further? Okay, so here are some issues that you can consider in deciding which variances should be investigated. Okay, let's discuss the activity question. Exercise 1124. Robertson Consulting uses a standard costing system to allocate overhead costs. The accountant estimated 8,500 hours as the volume to develop standard overhead rates. Budgeted costs were 19,125 for fixed overhead and 15,300 for variable overhead. The following results were reported. So let's stop at here for now. So which information that is useful for us to calculate variance? 8,500. So this is standard hours from master or static budget. Let's have a look at the data. Actual hours 8,500. This is the actual hours spent in the production. Standard hours 8,300. What's the difference between this and the previous standard hours? The standard hours here is the standard hours that the company allow for the actual production. In other words, this is standard hours from flexible budget. You already adjusted the standard hours for the actual level of production. The actual fixed overhead is 19,000. Actual variable overhead is 14,800. The first requirement is for you to calculate spending variances for fixed and variable overhead. To calculate spending variance, you need to compare the actual cost incurred and flexible budget amount. For variable overhead, actual cost 14,000. Based on a flexible budget, 8,200 times 15,300 divided by 8,500. Why $15,300 divided 8,500? This is the standard rate that you apply. So in total, it is so the result of this calculation is 650 favorable. What about fixed overhead? Actual cost 19,000. Flexible budget amount 19,125. The actual one is more. The actual one is less actually than the budgeted. Therefore, it is 125 favorable. Both spending are favorable, which means you spend less than what you budgeted. Now let's have a look at the next requirements. That's the overhead allocation rates for fixed and variable overhead. For variable, 15,300 divided by 8,500, so 1.8. That's the rate that you will allocate for variable cost. For fixed cost, 19,125 divided by 8,500 hours. Remember, the hours that you use here should be taken from master or static budget. That will give you equal to $2.25 for rate for fixed overhead cost. Requirement C. Calculate the production volume variance for fixed overhead. Production volume variance, remember, applied compared to budgeted. The applied one is 8,300 hours. This is standard hours from flexible budget times your rate, 2.25 equal to 8,675. So that's the total fixed overhead cost that you applied to the product that's completed. Budgeted is 1925. Therefore, volume variance, they applied one 18,675, budgeted 19,125. It is unfavorable. Okay, because there was unused capacity. The fixed overhead was underallocated. To check, standard hours 200 less, because based on your master budget 8,500. However, the actual hours that you applied for fixed overhead is 8,300 hours. The fourth requirement, D. Calculate the efficiency variance for variable overhead. To calculate variable overhead efficiency variance, the same, that budgeted compared to actual compared to applied. The actual hours is 8,200 times standard overhead rate 1.8. The applied one is 8,300 times 1.8 equal to 14,950. Because the actual one is less than what you applied, it is then favorable. Remember, the 8,300 hours is standard hours allowed for the actual production. So that's from the flexible budget. Another way of doing this is actual hours minus standard hours times standard hours. So that's the same. Will give you $180 favorable because the actual hours that you use in the production compared to the standard hours is less. Okay, a quick summary. A variance, simply it is the difference between the actual result and the expected performance, otherwise known as budgeted performance. Direct cost variance consists of two components, price and efficiency variance. Price, you compare actual price and standard price. Efficiency, you compare standard quantity and actual quantity. Variable overhead variances comprise spending and efficiency variance. Fixed overhead variances consist of spending and production volume variance. That's all from me for flexible budget and cost variances. If you have any question, let me know by email. Thank you. Bye for now.